All right, everybody, welcome back to the More Doors podcast. Today is episode 41, and we are about to do a data deep dive with the one and only Brian Underdahl. We'll be back with that episode right after this. All right, we are here, episode 41, More Doors podcast. I'm here with my very handsome co-host and brother from another mother, Brian Force. What's up, homie?
I'm doing well, man. How are you? Thank you for the compliment.
Of course, man. I shower you with compliments as often as possible, especially in the absence of our third leg.
Yeah,
good.
He'll be back next week, I'm sure.
I hope so. Yeah. We miss him already.
He's out working, though. That's the thing about Nick. He's never missing just because he's, screwing around. He's got a due diligence period he's working through. He's got all kinds of stuff.
We have like due diligence happening all over the place.
Yeah, which is
excellent.
A lot of fun.
Absolutely. All right, team, before we jump into today's episode with a fantastic, very, very intelligent guest, let's give a nod to our sponsors. Go check us out, deepbluere.com, Deep Blue Capital. You can check out the details of our ever-growing portfolio. Maybe subscribe to our blog written by the one and only Brian the Force.
Yeah. It's better every week.
That's it. It's a bunch of fantastic blogs. Take you right to our YouTube page, LinkedIn page, all that sort of fun stuff. So you can check us out on social. Subscribe to the newsletter. And if you're interested in putting some money to work, go register as a potential investor on the website.
Create that investor profile.
It takes 30 seconds, and we'll keep you up to date on all the latest and greatest with us, and some other opportunities that we hope to bring to market here in the very short-term future.
Absolutely.
Let's also give a nod to the one and only Jesse, best beard ever, Showalter, and Tor Studios, TORE studios.com. If you want to have a very fantastic podcast or any sort of ether-led multimedia support, give Jesse a shout. Tell him we sent you.
Make you look famous.
Yeah, he will make you look fantastic. Get your content out there and make you look extra, extra great.
That's fantastic.
You like that?
Let's do it.
Okay. Without any further ado, we have two Brians today. This could get confusing.
This is going to get really, really tough.
This is going to get tough, right? Tough with two
I'm
F's.
up for the challenge.
All right, let's welcome our guest, Mr. Brian Underdahl. Brian is Chief Analytics Officer at Nuvo Multifamily. Brian, welcome to the show.
Thank you very much for having me. Happy to be here.
Absolutely, brother. We appreciate you taking the time. And we'll just dive right in. I always love to have people share their backgrounds instead of us just reading your profile off LinkedIn. So give us the scoop. Who's Brian? You, Brian, not me, Brian. Who is Brian Underdahl? And give us the backstory, and then we'll dive in.
Sure. So me here. So I started out of undergrad. I was in sales. Transitioned into entrepreneurship. Had a sunglasses company for a number of years. And also got into to Forex trading, currency trading back in, I guess it was 2012. Did that for a number of years and actually didn't lose my shirt. Like it's very easy to do in that market. Realized that I was really into macroeconomic data, and I naturally was reading it because I wanted to understand what was happening in the currency markets, and enjoyed it so much that I decided to go back to grad school for applied economics. So that brought me to Tallahassee. I went to FSU, got in with a great group of folks that were running a hedge fund out of Tallahassee. Ended up working for them for a little while, and then we started a partnership together with a real estate fund that invested passively in syndication sponsors, operators across the Sun Belt and Southeast, exclusively in multifamily. Was with them for about 5 or 6 years. Actually, we still have a couple of assets under that umbrella. And I guess it was about a year ago, almost to the date, that Nuvo was formed, Nuvo Capital Partners. That's where I am now. Started it with two other partners, Lenny Pisano and Stuart Keller. Stuart had about 16 years in the industry as a asset manager, operator, and was one of the operators that my old shop wanted to invest with. So when he went out on his own and asked me to come along, kind of jumped at the opportunity. We saw some cracks, if you will, in the multifamily market, and kind of came up with a unique structure to capitalize on it, and that's what the Nuvo umbrella is formed for.
Amazing. So, so much to pull apart there. One of the things that kind of jumped out at me though is you guys came together almost a year ago to the date, right?
Yep.
When interest rates are almost at their peak, right? People were absolutely reeling from the great quote unquote adjustment on insurance and property taxes that happened pretty much coast to coast, right? Why did you think that was the right time to go do this?
Yeah, so a lot of it stemmed from my time at the old shop, where my main responsibility was essentially to vet sponsors and oversee the underwriting of deals. And what we saw was a lot of aggressive underwriting in the last few years leading up to starting Nuvo. Thought that there was going to be some problems. We even had some of the deals that we had previously underwritten. We had groups coming back to us asking if we could provide prep equity. And at first, it was just kind of one-off deals, and then we realized that there was going to be a lot of this, and so that's why we started this new umbrella. Was basically to focus solely on providing rescue capital.
Gotcha. So can we double tap into those two specific activities? Because we've talked a lot about both vetting sponsors and underwriting deals. We did a show probably 20 episodes or so ago where we had some other syndicators talking about how they've adjusted their underwriting in the new normal, if you will.
Yep.
But let's pull this apart. So when you said your job was to vet sponsors, what does that mean, and what exactly did you do in order to vet sponsors?
Yeah, it usually started with just an intro call, and I was actually doing the proactive outreach. So I was just Googling, multifamily operator Texas, multifamily operator Florida, and it's usually pretty easy to get in touch with somebody because we had capital and they wanted capital, so it really wasn't a cold call. And it just starts with a friendly conversation, asking questions about, where their focus is, if they have a live deal. But the crux of it was basically there needed to be a live deal, because everyone can say whatever they want to say, and most sound very, very good and polished in a meeting. But then you see how they underwrite, and that's really where the vetting begins, if you will, is comparing how we would underwrite the deal to how they've underwritten a deal. And I can go into more detail about.
Please do, because I think underwriting is really it is such a critical step. And to your point, I think there was a lot of deals being very aggressively underwritten in 2020, 2021, even into 2022, where rent growth was through the roof. Everybody thought it was going to continue. People thought cap rates were going to stay the same or compress further, and we pretty much moved into the polar opposite of that. Mm-hmm. And as a result, you have kind of some distress on the market. So please, dive deep into that. I think it's something that the listeners will get a big kick out of.
Yeah, you said something there that's probably the best place to start is the exit cap rate assumptions. Mm-hmm. That was the easiest way to quickly vet a model, is drop the exit cap or raise the exit cap 100 basis points and see what happens to the returns.
Right.
That's probably the quickest way to check it out. The other thing is, and this is happening more and more now, even today, we're seeing AAR used, average annual return, as opposed to IRR, which is the internal rate of return. Mm-hmm. The important piece of that is that if you use AAR as a metric, it's usually backloaded. So it means you're not getting the cash, throughout the life of the property. It's really all the returns are based on the exit cap assumption, or what your sale price is. And so that's wouldn't call it a red flag, but it's something that we look for. To your point about compression with cap rates, that was the name of the game leading up to 23. It's even the sponsors that said they were being conservative were still about 100 basis points off of where we would underwrite to.
Really?
And it was just It's recency bias. I mean, whatever's happened in the most recent past, you expect it to keep happening. So it's understandable that people thought rates would stay low forever. And the trouble we were having with it was that if rates are at rock bottom, they have nowhere to go but up.
Mm-hmm.
And so we were that was a way that we weeded out a lot of deals. The other thing, and this was actually harder to get to, it. I don't know if it was ever included in a model that we looked at, but yield on cost. Is something that we use, and since we have institutional equity partners and family offices, and so that's the first thing they want to know. IRR is great, but that can be manipulated pretty easily. Yield on cost, untrended yield on cost specifically is very hard to manipulate because it takes into account all of the costs involved in the deal.
Mm-hmm.
So if you're doing major renovations, it doesn't matter what the going in cap rate is. Because it takes everything into account.
Right.
And typically our investors and us need some spread over, your exit cap assumption to justify it. And that's usually around 150 basis points. So in general, right now we're looking for something north of a 7. And that's hard to find. It was really hard to find back then. And it's even harder to find right now.
So you're looking for yield on cost to exceed 7?
Yeah, in general, it's
Okay.
650 to 7.
Got it.
But and the deal factors in there too. If it's a Class A, you don't need that quite as high.
Right.
But it's institutional investors. It gives them a quick metric to compare it to other opportunities they could be investing in, and not just multifamily real estate. They have every opportunity to invest in anything they want to, basically.
Interesting.
So a good way to compare opportunities.
So how would you, or how do you, or how have you, because I think there's a paradigm shift that I kind of want to get to here in a second, but traditionally, how have you started at or gotten comfortable with an exit cap rate? So the typical thesis that I've used and learned from is that you take your entry cap rate, take it off the table, right? You look at your market cap rate in your asset class. And, again, prior to the last 12 or 15, 18 months, we would add anywhere between 15 and 25 basis points per year of hold time to the market cap rate. And that would be our forecasted exit cap rate. Do you agree with that, or do you use something different?
I think that's a great rule of thumb. It is. The tricky part with that is that you have to pretend or be an economist to really have an opinion of where rates are going to be. And as soon as you start playing with the exit cap assumption and say 5 years from now, you're betting that where interest rates are going to be 5 years from now. And quite frankly, nobody does. And so we always try to err on the side of caution by expanding the cap rate, like you said, 10, 20 bips a year. It also depends on the market that you're in and the asset class, if it's A, B, or C. I'll tell you that we're underwriting an awful lot of Class B and C properties and call it 70s, 80s, 90s vintage. Most of them we're underwriting to a 7 exit cap right now. Now this could change depending on the Fed, but we're not going below a 6 on the exit cap assumption.
Are you mostly primary markets?
Primary and secondary.
Okay.
Nothing tertiary.
Do you differentiate on the exit cap in a primary versus secondary?
We sure do. Yeah. So we've underwritten some, let's just call it a 90s vintage major market. We're in Jacksonville. That's our headquarters. We can go down to a 5.5, 5.75 on a newer construction vintage. But that's really the floor. And we actually, just as a general rule, we're just not going below that. It's hard to make that bet that interest rates are going anywhere near where they were 2 years ago.
Sure.
Mm-hmm.
And
where do you start with your your market cap rates today? Right? Are you getting that from CoStar or RealPage or any sort of other information score, or are you just so familiar with the area that you have that intel?
So a little bit of everything. So I consume all of that information. We consume all of that information. I got to be careful how I say this because we think it's very valid, but there's some bias that's happening in that data because most of what's transacting is Class A. People are still buying newer vintage Class A properties. And there's fewer transactions happening in Class B, C, 1970s, 80s vintage. So we have underwritten personally at Nuvo in the last year about $6 billion of off-market multifamily Class B and C vintage. And so we've constructed an index basically that we use internally. We share it with our investors too. And I think it's actually now live on our website. But to answer your question, we rely more on our own proprietary information than we do outside sources, just because we think that data from public sources is a little bit skewed right now.
Mm. Have you done any sort of analysis on what the difference in market cap rate spreads are between A, B, and C class in the markets that you serve?
Yeah, they're finally normalizing.
Thank goodness for that.
Yeah, right.
Yeah, you guys know everything got compressed so much that there was barely a spread between a C and an A.
Yeah.
Mhm.
And so a lot of institutional capital moved their efforts to A, because why not? There's no difference.
Yeah.
And that's finally spreading or blowing out, if you will. We haven't seen it in the data, again, because the transactions aren't taking place in the B and C. But I would say it's just more normalized. So if you have an A that's a 4.5, a B that's closer to a 6, and C that's closer to a 7, I wouldn't be surprised if C's end up getting closer to an 8, 9 in the near future, just to transact.
No kidding.
The issue with that, and this is what we've seen internally too, is that when you get to that point, the purchase price that you would pay for the property is now worth less than the unpaid principal balance of the loan.
So that literally was the question. I thank you for taking the words out of my mouth. I was going to say, how do you transact at that cap rate without erasing all the equity that the owner currently has? And it sounds like you don't.
Yeah, that's the unfortunate reality that we just realized in the last 6 months from our underwriting, is that, oh man, we can't, because our strategy, just to back up, was to actually, when we buy a property, include the seller in our deal.
Mm-hmm.
So they get to stay in, there's no risk of foreclosure. We restructure the debt and basically execute the business plan. Mm-hmm. And then everyone gets to, the sellers are a part of the deal, their investors are a part of the deal. The better we do, the better everyone does. And then as we've been underwriting more and more, we just unfortunately can't make the numbers work. And we're not shooting for some crazy return. This is just like mid-teen IRR. So that's we've run into that.
So I these are hypothetical scenarios. Obviously, we're on a podcast, so people can listen to this, so we don't have to get too crystal ball here. But it sounds like what you're describing is a little bit of, I call it almost like that Big Short moment, where you realize, like, oh, this is the big fundamental problem in the market right now. When you combine that with some of the underwriting on deals that did transact in the last few years, like you were talking about, so you have so you're using AR as a metric rather than IRR, and you're probably 100 basis points off on your exit cap rate. So those returns that you're projecting are pretty much shot, because they're backloaded and they were dependent on dispoing at a certain price to hit those returns. That's likely not happening now, and those cap rates that they would have to transact at for there to be a market to be made probably erases the equity you have in the deal. How do you unwind all that in this market? I mean, what needs to happen to reinstate a sense of normalcy in the marketplace when you've got those core problems to deal with?
Yeah, that's a great question. And I don't know that I have the answer, other than a couple of thoughts here. One is that there has to be a basis reset. Mm-hmm. And that's going to fall on the lenders themselves, I believe.
Yeah.
As of now, they're very resistant to taking any sort of discount to the loan. As far as an acquisition goes, we've had those conversations, and understandably so, especially if they're securitized into a CLO or something like that. Mm-hmm. They have restrictions on what they're able to do. But what I guess we'll timestamp this and pull out the crystal ball.
1958. Here we go.
I would expect that the lenders will quietly unload some of these with a few select equity partners, and try not to make it too public
Sure.
that they're transacting below the loan balance.
Yeah.
And they'll take a hit. Their investors will take a hit. It's not fun to lose money, but most of their investors have deep pockets. They'll be just fine. They'll move on. The unfortunate part of that is that even though the lender's taking a hit to reset the basis, the equity in the deal, the LPs that originally invested are wiped out.
Yeah. And that is obviously very unfortunate. It's unfortunate because this is, at its core, this is a banking problem. The difference between this and essentially, you talk about single family and the Great Recession and those types of things. That was essentially, a combination of a rate and income problem, meaning people were taking on loans that they fundamentally could not afford. And there was a lot of predatory practices going on. And it was a ticking time bomb because when those rates adjusted, people weren't going to be able to make their payments. And they really should have never taken out those loans in the first place. They were deceived. This is not that problem. This is a banking problem in the sense that we did have a lot of underwriting that was very sketch and deals that probably shouldn't have been done in a rate environment that was probably once in a lifetime. But we also had the fastest rate increase in human history as well.
Yeah.
And that is a conscious banking decision as well. So I think everybody's responsible for the choices they make, but I do see that there is some onus on the banking industry to take some of the brunt of this because, that blew deals up. You go floating rate debt that goes that quickly, that fast, that high, you're going to run into these types of problems.
Yeah.
It just is what it is.
I'm also, I agree with you that it's a banking problem, but it makes me question the thought process of the appraisers that were justifying the valuation that the banks approved to ultimately fund the deals, right? Did the appraisers that were justifying these prices, did they have access to the right data, or did they just think that the golden years were going to continue forever?
Same mistake. The past is going to be the future.
Exactly.
I love that you made the Big Short comparison. By the way, that's my favorite movie.
It's my favorite horror movie.
Yeah. Book's even better. But,
yeah, it is.
What happened then? There are a lot of parallels here in that the rating industries were, let's just say, looking the other way on how they rated the bonds that were, tranches of the CDOs.
Yeah.
And something similar happened here in that there was so much demand for private debt funds, for lending funds, that all the money flooded in there. And so all the debt funds need somewhere to deploy that capital. And so they started competing with each other basically for more aggressive underwriting.
Yep.
And it's very, very similar. Just like the ratings agencies back then knew that they would go from S&P to Moody's if they didn't give them the rating they wanted.
Yep.
The bridge lenders specifically, were competing with each other to get the notes and deploy the capital from their investors.
Yeah. It's one of these things that you look back in hindsight and seems so clear, but that comparison is perfect. I'm a capitalist by nature, like I think a lot of people in this room are, but the idea of being a subscribing client to a ratings agency and paying them a fee to make sure that you get the rating that you want, otherwise there are competitors in the space that will do it, seems like a really troublesome idea. But until the bomb goes off, nobody thinks about it.
Yeah.
Interesting times.
Yep.
For
Absolutely.
sure.
Absolutely.
So we don't, obviously we can't predict the future. We're going to have to unwind some things and obviously have a basis reset. But it does seem like at least the bid ask on deals that are getting closer to transacting, or I said the deal flow, the bid ask is getting a little bit closer. Do you feel like we're heading at least in the right direction? Some people are going to take some haircuts, but do you feel like overall we're getting closer to a normalized market in general?
I would agree with that. Yeah. Because it just, what we had for the last 5 years was just not sustainable. And so there has to be pain in a correction. Different people feel the pain differently, but I do agree that we're getting to a more normal, if you will, market, just the spreads alone.
Yeah.
And interest rates, they're not supposed to be zero. You're not supposed to finance a 400 unit apartment complex at 3%.
Right.
It's just not normal. So yeah, I agree with that.
That's fair. I think a 400 unit apartment complex should charge a little more interest than a Honda Civic.
Probably.
Makes sense.
Actually, I don't know if I agree with that, because the apartment complex is a fixed asset and the car can wander off.
That's true.
I feel like there's a lot more risk.
It's easier to find the apartment complex if you need to take it back.
Exactly.
That's
exactly. Nobody's stealing the catalytic converter off an apartment complex.
And ideally, the apartment goes up in value after you drive it off the lot, right?
Absolutely.
So
exactly.
really
that makes sense. I take it back. You guys are right.
So Brian, I read an article the other day by a very successful multifamily syndicator. I'll leave their name out. And it was about the argument that given the amount of time that rates have already been at a, however, 23-year high, and inflation tamed, but still a concern, that there's an argument to actually underwrite for lower cap rates than higher, thinking that as the market continues to peak, we go through this distress, right? That interest rates start to come down, cap rates follow gradually over the hold period. Do you have a perspective on that?
I do. Yeah, boy, there's a lot to unpack there. So on the surface, I think I disagree with that. Couple of reasons. One is, and maybe this is just kind of framing the perspective, but you're just making an interest rate play at that point. You're not relying on the cash flows of the asset, of your ability to increase NOI, keep expenses in check. You're lowering the cap rate to make the deal pencil, is what my gut reaction to that is. And maybe with retail capital, you can make that argument, but with institutional capital, at that point, you are just betting on rates.
Yeah.
And they have much better ways to bet on rates than the risk of operational risk of a multifamily property.
Yeah.
So we would never be able to make that argument ourselves. Basically, that argument is just that they're going to come down. And we're not even willing to make that bet right now. We've at Nuvo, since we started last year, we've been projecting 1 to 2 interest rate cuts for all of 2024.
Yeah.
Obviously, at the time we were doing that, it seemed crazy. They were pricing in 7 cuts and then 6, then 5, then 4. Now I think we might not have been conservative enough. We may not see a rate cut this year.
Yeah. It's almost like the government isn't always honest with us.
Stop it.
I'm not going to touch that one.
Yeah, I think that's a very fair argument. It did get me thinking, though, that same article, and I would pose this question to you. From a conservative underwriting perspective, is there any market environment in general, where you would ever be comfortable underwriting for a lower exit cap than you're entering at? And the reason that I ask is obviously asset value is just a function of NOI and cap rate. And so if we forever had rising cap rates in our underwriting, then at some point, infinitely higher cap rates, you wouldn't be able to improve NOI enough to actually make asset values go up over the hold period. Eventually, you'd hit a vanishing point where you'd be buying depreciating assets, right? But you always conservatively, for the most part, underwrite for a higher cap rate. Is there any environment where you'd be comfortable underwriting for a lower cap rate?
On the surface, I would say if you had some reason to believe you were drastically going to increase the NOI.
Yeah.
Which, of course, that's just a function of the cap rate.
Sure.
Just to kind of play devil's advocate, it's hard right now to see how we could end up expanding cap rates further and further into the future. As you said, at some point it's depreciating. Well, that's exactly what happens if interest rates continue to go up.
Yeah.
It's happened before. It happened big time in the 70s. So I guess our stance on it is you can't really rule out something like that happening. I believe that the Fed is more concerned about inflation getting out of control than they are causing a recession. I think if they had to choose one or the other, they would say, okay, cause a recession. Don't let inflation get out of control. And I guess sitting here today, let's say that we think that things are coming down, there's a soft landing, and we're underwriting currently at a 7 cap on, let's call it a 90s vintage deal, maybe late 80s. And we, have a solid business plan. I could see, underwriting at the current or going in cap rate, buy at a 7, exit at a 7. But that's not our base case with anything.
Right.
And if you under promise and over deliver, it's only a good thing.
Absolutely. And you're just describing the falling knife scenario. So why even make that a function of your model if you can, if you operate the property in according to the business plan and execute on every other lever, then you should be going in at a price that is conservative without a lower cap rate.
Yep.
Otherwise, you're just also betting that the market is going to go a certain way.
Agreed.
Yeah.
Agreed. So Brian, let's think about our audience here for a second. We have kind of a wide swath of folks that are maybe early in their multifamily investing journey and looking to hear from the best of the best like you. We have some more experienced operators and syndicators that we've had on the show and subscribe to the show. But let's talk about that first tranche a little bit. And if we think about underwriting as a discipline, and the very practical series of events where you go to a broker's website, you download the rent roll, the T12, the OM, and probably get your hands on the obligatory CoStar report. You flip through that CoStar report and you plug in your rent growth assumptions and whatever CoStar says your exit cap rate is going to be in 5 years based on asset class. I'm done, right? I've underwritten the deal, and if it checks the box, now I can go, file my stuff and go start raising money. How have you, or what guidance would you give to folks on how to be a little bit more sophisticated about their underwriting processes and really make sure that they're getting into the data to justify what is and what is not a good opportunity?
Yeah, that's a great question. I would say that internally we use a lot of sub-market data that it's publicly available. You can go to the Federal Reserve's website. It's St. Louis Fed, and you can pull employment data, income data, all that stuff. A lot of the stuff that CoStar has, and then an awful lot more to really dig into the submarket. We do some more, I guess you could call, complicated regression analysis on that data. But for somebody getting started, I think the easiest way to use it is just pull the data set that you want. If it's let's say construction employment or something like that within that market, and just see what the trend is. You don't really have to get too complicated with how you're analyzing the data on the surface. So you can pull 100 different data points in a county and just see what the trend is. Is income going up? Is employment going up? Is the population growing? Those really simple metrics will just, if you incorporate those into your underwriting, you can at least get excited about the market. There's a lot of times when higher income classes move from one part of the market to another. And unless you have boots on the ground, it's hard to know that. Then when we dig into the deals we've looked at, we realize that, let's just use Atlanta as an example. Oh, this is, if you want to be in Atlanta, great, big city, good market, but then there's pockets where you maybe don't want to own an asset. And so using that data that, again, is publicly available will at least tell you if the submarket is moving in the right direction.
Gotcha. So why is construction employment an important metric to you? You called that one out first.
Yeah, we actually did a piece on this, looking at correlations and regressions to see just, what effect this has. But we found that it's actually a pretty good leading indicator for just the general health of a submarket or an economy on the macro level for the U.S. and then also within the submarkets and cities. The paper we did on it was just looking at a correlation between construction and an apartment price index, which again is on FRED. So there's an index that kind of tracks pricing of apartments. And most things are cyclical, and it turns out this is too. So what you typically have a run up in construction employment because there's strong demand for apartments, and that's typically where you see the run up in prices for apartment buildings. Then once there's been an awful lot of growth in the construction, you end up with an oversupply, which is what we're experiencing right now. And it hasn't happened yet, but I'm guessing that we're going to start seeing construction employment numbers drop in the near future as projects get stalled out, put on hold, and we can already see in the data that permits have been, basically fallen off a map right now.
Yeah.
So you can almost look at it. The data tells a story, and you can kind of see the cyclical nature of all of this, and that's why construction employment specifically is something we like to look at.
So let's play that out for a second, because there's a correlation here. So I think we're all looking at this incoming supply, this tidal wave of incoming supply through the rest of the year, even into 25. And now they're saying Austin and Houston could be into 2026, right? But to your point, right? Those projects are still ongoing.
Yep.
So construction employment, in your example, would probably still be strong. Now, operators, investors are like, okay, well, let's get through this incoming supply tidal wave, and then rent growth is going to happen again. So that should be good for our deals and good for our portfolio. But if permits are down, I think I saw something like yesterday from Jay. It was like permits in Dallas were down 40-something% year over year, right?
After already being down quite a bit.
Correct.
Previous year.
Correct. And so permits are down a lot, but construction employment's high right now. Without any building coming in, we would think rent growth is going to go up, but with that fewer construction or less construction employment out a year or two, you may look at that and say this is a warning sign, or maybe this makes more of an unattractive market. So how do you think through that kind of conundrum that's going to happen here in the next 12, 18, 24 months?
That's a great question. So that, I would say, is very market specific or dependent. So yes, construction employment might fall. It also tends to be correlated with recessions. But it's hard to really tease out that, because construction's falling, we're in a recession, and therefore apartment prices aren't going to rise or rents aren't going to rise. So my gut to that one is that just because construction employment is falling doesn't mean that rents won't be able to increase in a certain market, because there's 100 other types of employment other than construction. But if there's an area that relies heavily on construction, industrial in nature, then that would have a much bigger impact on the local market. So I guess the roundabout answer is it depends on the market. But it's certainly something that we factor in along with quite more than a handful of other variables.
Gotcha.
Sure. It sounds almost like, the big distinction to make. It's always an important variable, but in specific markets, is it a leading or lagging indicator?
Mm-hmm.
Meaning, in North Texas, a great example. So we are not an industrial area by any stretch, and we're a very built out and robust local economy already. So the construction job metric falling, off, going way down as no new permits or no new units are coming online, might be a leading indicator of rent growth because not a lot of new supply coming online.
Mm-hmm.
Whereas if it's a leading indicator in a industrial more focused area that they're not building much of any type of construction, then the economy is going to stop growing, and so that could be a leading indicator that you're gonna have a tough time in that market. So I think it like Brian said, it's very market specific, and you got to know a lot more about the economy than just that one metric.
Yeah, I guess as I think about the idiocy of my question now, like all the people that are probably working on multifamily projects, when those are done, they can probably go work on single family or find some other things to do. I guess it's not just multifamily construction that we're considering.
I guess that's true. Yeah, it depends on what else is going on in the
tape
market.
measures to tape measure.
That's fair. Framing is framing.
Well, in a lot of multifamily, it's not local construction crews all the time either. So
that's true.
Fair point.
We've got a crew that comes in from Tampa for a project in Louisiana.
So those numbers might be a little off. Depending on whether they're using local crews or not.
Yeah.
That's an interesting caveat.
So Brian, if you think about your radar, right, from a macroeconomic perspective and obviously someone that's represented some very big investment outfits, how do you set up your radar to know where the hottest metros are, where there's a lot of growth happening? How do you funnel that data to you, and how do you go to start to take next steps on figuring out with the, if there's up and coming markets or that you want to invest in or even pull out of?
Great question. That's where I get excited, really, from the data science perspective, because a lot of this data is publicly available. In fact, I've got 10 tabs from the Federal Reserve website open right now. You can pull that data, run a regression on you have to have some sort of theory or thesis. And I realize that not everyone can just start using a data software package. But that's how we do it. Is okay, we have an asset in a market. Let's just say that we're not as familiar with it. I just start digging in and seeing what the correlations are and how they compare to other markets. We did a really interesting project. I can't go into too much detail on it, but in general, we look at pre-COVID trends in certain submarkets for everything, for income, employment. We look at what trend was prior to COVID. And then see, obviously all bets are off when COVID happened, everything kind of went crazy. Sure. But then we look at if that trend continued on without COVID, where should those numbers end up? And then see if those markets are actually hitting those numbers or not. And it gives us a real good sense of have these markets actually recovered from COVID. Everything improved everywhere after COVID because it had nowhere to go but up.
Right.
But like, how much did it actually improve, and is it back on track, and is it exceeding the pre-COVID trend, which would be a really good indicator of long-term growth and health of a market.
Yeah, that's what we were doing that, right? When we were looking at like market analytics, we were checking out the pre-COVID.
We wanted to look at
the old normal,
18.
Yeah,
so, yeah, and I mean it makes perfect sense.
Prior to all the masks.
Yeah, all the masks, and, all the other stuff.
You'll find those in like glove compartments and stuff when I'm walking.
I know. You pick up an old jacket, you find 3 folded up, nasty face masks in your inside pocket.
This is a weird nostalgic thing now.
It is.
Like,
it is. Still had one of those?
Yeah. Exactly.
So Brian, when you we want to be conscious of time here, and let's get back to your day. When you look out to the projects that you're looking at, the team that you've constructed, and kind of Nuvo's investment thesis, like what are some of the assumptions that you guys are making about the economy, and how can people take this episode and make it actionable?
Yeah, that's a great question. I would say that what I say to you today about the economy may be very different than what I would say even a week from now. So we're very data dependent and plugged into what's happening and trying to just kind of let that drive our decisions. As far as some general rules, I mean, just be more conservative than you think you need to be. That's kind of a rule we try to live by ourselves. The timing thing too, try not to be in such a rush to close a project, or find a way to make the project work. Just to do it, because there's going to be lots of opportunity here, and the worst thing you can do is kind of force yourself into a project just to make it happen, or an acquisition, and it's painful right now. I think for everyone, this is probably one of the toughest environments to get a deal done. Just there's a big gap between what sellers are willing to sell for and what buyers are willing to pay. That'll normalize. It is normalizing now. And I guess use the resources that are actually out there, like Federal Reserve website, to pull data, and don't try to use that data to fit your narrative. We go into it trying to find a reason not to do a deal, and we use the data to play devil's advocate. And that's maybe, saying it out loud, that may be the single best piece of advice, if you want to call it that, that I could give, is try to find a reason not to do a deal as opposed to the other way around.
Nice. What do you think? What do you think the rest of the 2024 and into 2025 looks like?
A little bit more pain.
Yeah.
Unfortunately, I think it's just valuations got so so high. And it wasn't like it happened quickly. I mean, it happened very quickly in the last few years, but we've been running up since 2012. So we've climbed very high, and there's still good ways to fall, I think. And that's going to take a little while to play out. You can still find good deals, but all of the supply is coming online. That's got investors scared. It's got me excited because it's, valuations are falling in relation to that, and it's a good time to buy. You can look at the data and see that the permits have stopped, and that supply will be absorbed, and things will balance out. That doesn't mean that it's going to take off again like it did, started doing 5 years ago. We think it's going to be more of a, I think it's going to be more of a gradual, normal, healthy market after this shakeout.
Yeah.
But I do think to answer your question specifically, the rest of this year is going to be tough, and 2025 is going to be tough because a lot of the cans have been kicked. We saw some cracks in 23. We're seeing more in 24, but based on our relationships and the deals that we're looking at, we know that there are deals that should be in trouble right now that are being kicked at 25. And so I think originally I thought, and I think a lot of the market thought, that 2024 was going to be this wall of maturities, everything hits the fan. Turns out lenders, banks are pretty smart, and they're finding ways to keep that from happening. And so what I think could happen is that we have more of a slow, not trickle, but slow, these troubled assets come to the market more slowly to try to control the bleeding, if you will.
Yeah.
Nice.
Yeah, makes perfect sense.
Totally makes perfect sense. One last question, or kind of work related question. So you mentioned that you use data analysis software.
Yep.
I used to work at a business intelligence startup. What do you use to do all your
I'm an R guy, R studio.
Okay.
I wish I was a Python guy. I had the choice in grad school of which one I was going to focus on. And turns out AI loves Pythons, and I'm in the wrong camp. So yeah, I use R studio. And honestly, GPT is pretty awesome.
Yeah.
It can help with a lot of that rough data cleaning. That is, in my opinion, the worst part of data science, is just getting the data into a usable format. And it's been pretty good at helping with that.
Yeah.
Awesome.
Love that, man. Well, Brian, we truly appreciate the time, man. Thank you for coming on. We'll have to catch up more. We'd love to see how your philosophies and everything, insights play out over time. This has been a pleasure, man. We really appreciate it.
Thank you both very much. This was awesome.
How can people find you, Brian?
Yeah, you can go to our website. It's nuvocapitalpartners.com. You can go to our page on LinkedIn, that we're pretty active there. Have a newsletter that you can sign up for and actually see some of the research that we referenced today.
Love that.
I'm gonna go subscribe to that. I'm gonna smash that subscribe button.
Smash that subscribe button on nuvocapitalpartners.com. Then head on over to deepbluere.com. Make sure you create your investor profile. Check out Tour Studios, TORE Studios, for all your content needs. Episode 41 in the books. Brian, we appreciate it, man. We look forward to talking to you again soon.
Thanks a lot.
Best of luck, Brian. Thank you.
Take care.